Larry, there's a lot of focus out there right now about the pace of rate hikes, the number of rate hikes. There's a little bit less discussion, though, out there right now about the balance sheet, the potential balance sheet runoff that Jay Powell has said he would provide a roadmap for at this meeting. What does a reduction of that $9 trillion balance sheet mean, if at all, for the inflation mandate?
Look, I think it's the right thing to do. I think, frankly, it's well overdue. It was very hard to understand why, when we were in the midst of the biggest house price run-up ever, that the Fed was buying mortgage-backed securities on a substantial scale. So I think the move towards rundown of the balance sheet is overdue and appropriate. I don't think it's going to have a large independent effect. I think much of the effect that balance sheet moves have had in the past has been because of their signaling impact on monetary policy rather than their direct impact. But it will certainly add to the monetary tightening that we're going to see. People have estimated that it may be the equivalent of one or possibly two. I think one's a bit more likely, 25 basis point rate hikes.
And when you pair that with the rate hikes that at least the Fed says are on the table, a potential 50 basis point hike at this meeting and maybe another one at the meeting in June here, do you think that that would give the Fed, I guess, enough ammunition to tamp down inflation, or would they have to continue going forward with additional rate hikes?
Look, I think it's hard to say. I think ultimately inflation depends on financial conditions, and what happens to rates is one important part of it, but it's certainly not the only important part of it. My guess would be that the Fed's going to need to go further. I think that in order to reduce inflation, you need to raise real interest rates above their neutral level. If we've got 3 or 4% inflation and the neutral real interest rate is, as the Fed believes, 0.5%, then you're going to have to be up in the 4.5, 5 range to get inflation meaningfully down. Right. And that's my best guess. I think the Fed's making a mistake when it speaks of raising rates above the neutral rate and treats that as meaning rates above 2.5%, because that 2.5 is only the neutral rate if inflation is down at the 2 level, which is what the debate is about. So my best guess is that rates are going to have to go up more. If they don't, it will be not so much because we suddenly get good news on inflation, but will be because we get worse news on the economy than many people expect. So I think we're looking at a pretty difficult situation.
So when it comes to the news on inflation, though, I mean, we have the latest employment cost index, which was released this week, showing that the employment cost index rising the most that we've seen on record in the first quarter here. We know that wages, compensation, benefits tends to be much more sticky, less transitory than some of the other elements of inflation out there. How would you suggest that the Fed address that?
Look, I think that we should be thinking in terms of wage or labor cost inflation as a kind of supercore measure of inflation. Seems to me it's hard to escape the conclusion that it's running at 5.5% or more. And with labor markets tight and creating several 100,000 jobs a month, I think it's likely that rates are going to rise further of wage inflation. And that suggests to me that while used car prices and semiconductor prices and oil prices will fluctuate month to month, that we have an underlying rate of inflation increasingly being baked in that is well above the Fed's target range. And that's why I think they need to be raising rates above the neutral level. They could somehow get lucky on this. It could be that we're going to see wage inflation subside of its own accord. But gosh, as I go around, as I talk to people, what I see and hear much more is labor shortage talk, the need to ratchet up wages to hold on to workers, the need to ratchet up wages and labor costs in order to attract people, the pioneering of new kinds of employment benefits that are costly in order to maintain the morale of workers. And all of that, I think, contributes to inflationary momentum.
All right, so as the market sort of focuses in on the Fed, and I guess more importantly, whether the Fed is willing to sort of stick by this sort of reduction in accommodative policy, a lot of people are looking overseas, Larry, and the decision this week by the Bank of Japan to effectively maintain its accommodative policy for a much longer period of time and signal at least to the market, that they're fairly comfortable with the weaker yen and some of the knock-on effects to their economy here. When you see that move there by a major bank like the Bank of Japan, how do you think the reaction would be if the Fed itself were maybe to pause their accommodative cycle?
I think you got looking at very different situations in Japan and the United States in terms of inflation. In the United States, we've got inflation at a place where the American people regard it as a huge problem in a way they haven't for 40 years. We've got almost every leading indicator of inflation pointing upwards. We've got epically tight labor markets. I think the situation's very different in Japan. I think their situation still has more in common with the pre-COVID situation we had in the United States, where you're trying to overcome a force of secular stagnation, in their case, I think driven substantially by the fact that they now have a quite rapidly shrinking labor force. So I think their decision in a very different context has been broadly appropriate.
All right, Larry, I have to ask you about the other big news, kind of overshadowing everything else, was the news here that Elon Musk, of course, the CEO at Tesla, has made basically a personal bid for Twitter, a bid that Twitter itself has accepted, and now we sort of await for shareholders to weigh in on whether they're willing to accept this deal. What were your first thoughts when you saw this?
I think it's worrying when America's wealthiest people on a private and individual basis own America's most important communications platform. I think that at least raises questions about how well democracy is going to function. And my hope would be that we could have some, I don't think it'll happen, but I would hope that we could have some serious bipartisan dialogue and soul searching around those issues. It may be that ultimately they will be stewards of a very responsible kind. On the other hand, I remember learning in my high school history courses, and I don't know what exactly is true, that the Hearst newspapers got us into the Spanish-American War because that's what William Randolph Hearst wanted to do. And he was able to use his newspapers to stoke everybody up with incidents that might have been true and might have been false. And it seems to me that as I look at what's happening at Twitter, as I look at, and I think the stewardship has been entirely responsible to this point, the world's second wealthiest man owning the Washington Post. I think the questions need to be given very serious thought. I'm not prepared to make a public policy recommendation, and I know of no basis for thinking that this transaction has anything illegal about it. But I must say, I'm uncomfortable, and I think there really does need to be some serious reflection.